Good afternoon and welcome to this pre-recorded webinar from Dun & Bradstreet titled A Unified View of SME Credit Risk. My name is Stephen O'Toole and I'm a Senior Marketing Manager in the Finance and Risk space. And today I'm joined by two of my colleagues. Firstly, Grant Hickson, who's a Senior Economist based in our Country Insight Group, and also Ravi Sidhu, who's a subject matter expert on all things credit risk. So we're here today to bring you some data insights from within the business. And I guess it's fair to say that these are uncertain times for UK PLC, right from high street stores through to financial services. But obviously the businesses within the country still need to sell goods and services, and lenders and credit providers still need to provide capital in a prudent way. So I guess the question is, how can you identify the good businesses that need the financial support to grow versus those that are likely to fail? And that will be the subject of today's short presentation. So Grant, if I could hand over to you first for the macro picture. I think you've got some really interesting slides today, specifically through the SME lens.
Thank you, Stephen. The timing of this presentation taking place as we enter the second quarter means that I'm able to share some cautious optimism in this UK macroeconomic outlook. Had this webinar been 6 months earlier, I might not have had such a positive story to share, but a lot can and has happened in 6 months. And we think there's more positivity to come. Hopefully the headwinds that have battered the UK over the last year have died down and there are calmer days ahead. One of the main headwinds that businesses have been up against can to some extent be defined by the cost of living crisis. The cost of living crisis has been and continues to be particularly challenging for SMEs. The cost of living crisis is described by the cost of everyday essentials like food and bills increasing more quickly than average household income, represented by the light blue line on the chart, which is inflation, being above the dark blue line, which is nominal wages. For businesses, it's been a confluence of factors. High inflation has contributed to rising costs for products, materials and staffing. The energy crisis has sent energy bills rocketing. Pandemic-related government support has been scaled back, and supply chain disruptions have lengthened delivery times and increased costs. Borrowing costs have also leapt over the past couple of years. And although inflation has now slowed, meaning that the rate of price increases has eased, price levels are still high. Inflation at the start of the year was still over 4%. This relationship between prices and interest rates is a key theme of the macro picture. Next slide, please. So how have UK businesses responded? If we take a moment to look back at the tail end of last year, the economy was in recession, inflation was well above the Bank of England target rate, and interest rates were still elevated with little guidance on when they might be lowered. Since then, only one of those three factors remains in place. Output data implies that the economy has potentially returned to growth in January. Inflation has eased considerably, more so in the headline measure. The second round effect of inflation on wages is starting to come off too. The one that hasn't changed is interest rates. However, what we have had at the March meeting of the Bank of England was the clearest signals yet that the bank was ready to consider loosening monetary policy. In my opinion, they sound increasingly positive about the economy and are confident that the effect of higher interest rates on inflation, on expectations and on wage setting is working. The upshot is that the bank is looking progressively more likely to cut interest rates for the first time in June. And while lower interest rates are encouraging for SMEs, an important caveat to consider is that while borrowing costs will be coming down, monetary policy will still be relatively tight for many quarters. Interest rates are unlikely to fall off a cliff. But looking forwards, the bigger picture is that softer inflation will create a better macroeconomic environment, and that's potentially starting to come through in the data for this year already. So with 80% of smaller SMEs directly affected by price rises, how have firms responded? Well, they tell us that they've increased prices and that they've scaled back growth plans, operating costs and staffing hours. The majority have had to absorb costs. Larger SMEs tend to soak up extra costs, perhaps having greater resources compared to the very smallest SMEs. SMEs have also passed on cost increases to consumers, which is borne out in high consumer price inflation. Next slide, please. The Bank of England has been attempting to choke off demand, which is that part of the economy that the bank can directly affect, by raising interest rates, making borrowing more expensive. I don't think that we've yet seen the full effect on businesses of rising rates. One of the challenges that the Bank of England faces is that there is a lack of spare capacity in the economy. And spare capacity is created when demand is destroyed. When an economy is weakened, perhaps through recession, for example, warehouses close, it creates spare capacity, but in a very painful way. What's happened over the past 12 to 15 months has been the successful creation of softer demand, but without meaningful recession. However, we now find the economy with very little spare capacity that may have been created had there been a regular recession. And so the Bank of England is nervous about cutting rates for fear of eating into whatever spare capacity remains and then just stoking inflation again. Another challenge is that monetary policy works with long and variable lags. And what that means is that the transmission in terms of timing and magnitude from a rise or cut in interest rates to it affecting the real economy and things like savings and mortgage rates isn't fully understood. For example, most UK homeowners who have a mortgage have a fixed rate deal. UK homeowners are currently facing a huge rise in payments when fixed rate mortgages expire. This doesn't just affect homeowners, as renters are also being squeezed as landlords pass on higher costs by pushing up rents. And this has an impact on businesses in two ways. Business owners are themselves likely to be homeowners and so face the same rise in housing costs. And two, in terms of their customers, a greater proportion of incomes allocated to housing costs means less left over for discretionary spending, so fewer or smaller customers. Put simply, reduced consumer demand leads to decreased sales and revenues. When asked how confident firms were about meeting current debt obligations, larger SMEs tended to have much higher confidence than smaller SMEs. Only a quarter of the smallest SMEs are highly confident in meeting debt obligations. I think it's also instructive to understand that the very smallest of SMEs tend to not have any debt obligations, implying that smaller firms may be unable to access finance or are seen as by lenders as carrying greater risk. Next slide, please. 99.3% of UK businesses are small businesses, accounting for some 5.5 million firms. And together they employ some 16.5 million people in the UK, which is around 60% of the total number of people employed by private sector companies. SMEs are the backbone of the UK economy. When they do well, the economy does well. And next, we'll take a look at what's holding them back. So using our data here at Dun & Bradstreet, we track business closures in the UK by sector. What we find in the latest data is a sharp increase in the number of bankruptcies over the past couple of years, to 25,000 last year alone. Businesses have come under pressure, particularly last year. Much of the rise in business failures in 2023 has been in consumer-facing sectors, such as restaurants and retail. Some 3,500 restaurants went out of business last year, compared to 2,500 in 2022. And about 500 more retailers closed shops in 2023 compared to the year before. Soft demand, the withdrawal of pandemic and energy-related support measures have really squeezed SMEs in the UK. And though interest rates are to fall from current levels, they're unlikely to reach the post-financial crisis lows. So we expect insolvencies to continue to rise in 2024, albeit at a possibly slower pace than in the previous year, as some of the driving forces lose steam and are replaced with a gradually more supportive business environment. Small businesses with less diverse revenue streams and greater difficulty accessing finance are more likely than larger firms to struggle this year. And a greater unified risk understanding of lending and credit profiles helps match lenders and borrowers. Next slide, please. So at the top of this webinar, I suggested there are reasons to be cheerful. And I think if we compare a forward view of the UK economy with where we were 6 or 9 months ago, things certainly look more hopeful. And I'll close this section by taking a look ahead with our Global Business Optimism Insights, which is a quarterly survey that we conduct of 10,000 businesses of different sizes from 32 countries and across 17 sectors. Firstly, we ask businesses a variety of questions about how they view current performance and expectations across things like sales, new orders, liquidity positions, how easy it is to raise funds, and how they perceive the level of financial risk. Secondly, we compile those responses into a huge database. And then finally, we blend those answers into 5 distinct indices to tell us things like how confident businesses are about making investments, how reliable their supply chains are. What the Q1 results tell us for the UK is that generally UK firms are feeling more positive about their prospects than at any time during last year, and that the recession may already be behind us. UK businesses have adjusted their expectations about borrowing costs, reflecting a change in market outlook on the pace and magnitude of interest rate cuts, which are now expected to begin later than previously anticipated. Larger firms tend to have a more favourable view, but in the very latest survey, all size firms are more optimistic about their businesses than at the start of the year. There is, of course, variance across sectors. Accommodation and food services are performing well, indicating an improvement from the cumulative impact over the past few years following the pandemic. The UK supply chain index fell in the last couple of readings, reflecting growing concerns that supply chain disruptions, including to major trade routes, may be lasting longer than initially expected. A theme that we interpret running through the responses we get from UK firms is that uncertainty is still high. They tell us that in uncertain times, familiarity is important. Small firms prioritise growth in existing markets, whereas expansion abroad is important for larger sized businesses, which are perhaps better equipped to deal with the demands of overseas trade. And on that positive note, I'll hand back to Stephen.
Thank you so much, Grant. Some great insights there, and hopefully some cause for optimism for both SMEs and those that are supporting them in the UK as well. So Ravi, if I could now turn to you, obviously as a credit reference agency, Dun & Bradstreet have access to this really rich stream of data via the CCDS scheme. So I was wondering for the audience if you could give a bit more background on that scheme and a bit more information on what business lending volumes are looking like within different product sets.
Sure. Thank you, Stephen. So the CCDS scheme, also referred to as the Commercial Credit Data Sharing Scheme, can be used to make credit decisions on SMEs with a turnover of less than 25 million. But it's equally as useful to understand trends within the SME market, because we have that view across the market with all the providers that are sharing their data with us. So what does it show from a new business perspective? Growth has been somewhat subdued for loans and cards to date, certainly in the last 2 years. And mortgages are significantly down from a peak in July 2021, down by 66%. That is a combination of maybe the lenders tightening their risk appetite and the quality of applicants out there, but there's also an element of SMEs making a choice of when they want to maybe invest further within their businesses. Now, the whole picture is really revealing when over and above that, you look at the asset finance area, which is actually being quite buoyant. I guess the question really is that a good bet for lenders moving forward? If we look over leaf on the next slide, what you'll see is that delinquency levels for the last 2 years have been relatively stable. Looking further at defaults, what you'll notice, off a very low base, there has been a slight increase in recent months and a spike in the middle of 2023. So there is some signs of stress there. So as much as there is growth within this sector, there is some sign of stress. And there is protection, obviously, when you are providing lending through asset finance, because there is that collateral to collect on. But it's still on lenders to lend responsibly. So it's an area that should actually be part of our focus over the next couple of months in terms of how we look at what the trends are and whether this is a trend that's going to continue. In terms of other data sets or products, business loan defaults have been at elevated levels for quite a while now. Now, the last time they were much lower was in 2021, and they are now 50% higher. One of the real interesting points here is that with the proportion of defaults that you see, which is based on the value, it's actually widening when you compare it to the number of defaults. And what that implies is that the value of the loans that are going into default are much higher than they were previously. So again, something that could be a worrying trend if this continues, and something to monitor and look at over the coming months. Moving over to the next slide in terms of current account turnover. Now, this is one of the most insightful data sets within CCDS. In previous voluntary arrangements, there wasn't this insight on the current account, giving you a view of the inflows and outflows of the account. And so, it's really useful to understand what's really happening with a business. So post-COVID, what we can see in terms of turnovers on accounts, the average credit turnover and the average debit turnovers have been actually increasing since the COVID period. When you look deeper, what you then notice when you look at the difference between those positive and negative inflows, you see that actually there's a trend that's probably been happening in the last year or so, where the inflows have been net negative for SMEs of roughly about £500. Now, obviously, there's going to be SMEs at both extremes, some that are getting by perfectly well, but at the other extreme, there will be some that will be feeling more pain than even £500, something significantly more than that. So it really highlights the variance in what's happening within the market. And this is just a commercial lending view. If we were to introduce both the consumer trends, I think it would show different insight again. And that's something we're hoping to share with you over the next few months. So if we can move on to the next slide, really, it highlights all of those factors that Grant mentioned earlier around inflation and finances being strained. It's clear that SMEs are experiencing challenges across all angles, whether it's the macro view or whether it's just the day-to-day harsh realities that they're facing. But SMEs are just like you and me. They're not immune to the pressures that we all face as consumers today. And this underlines the need for having a fuller view of what's really happening with those individuals. So really the question is, why is it important, to look at these additional data points? Well, the real outcome that we're looking for in terms of credit decisioning is being able to identify those businesses that are going to be the best opportunities and actually weeding out the riskiest businesses and focusing in on those lowest risk ones. But there's a whole range of business in between. And how do you then pick out which ones may be having some struggles but are going to pull through? And that's really where the additional insight could be of real value. And just a reminder here, you have to remember that there are 5 million SMEs in the UK. So that's a significant opportunity for all businesses that are looking to lend. So how can you do this with confidence? Now, it's a problem that we've been solving in order to help lenders and larger organizations and smaller organizations that work with SMEs. So to introduce the DNB Unified Risk View, really it gives you that ability to make those accurate credit decisions on small businesses, to do it in an efficient way and to do it so that you're profitable. It's there to actually help you manage the financial risk, by using the underlying data, but also predictive intelligence. In effect, it's a one-stop shop so that you can actually pull and use the elements that you need to make that right decision. So if we look beneath that, what it shows is the data that powers that. So Dun & Bradstreet has had very strong heritage within business data, and that's been well established for years. Over the last few years, we've actually overlaid the CCDS data, and more recently with consumer data. And by pulling all of those data sets together, we're able to provide that fuller view or that unified risk view. Now, obviously, there are permissible use cases where you can use that data, but what should be remembered is that it's for any SME, whether it's the larger ones, going right down to those micro SMEs, where it could really give you the insight and help make those decisions. So the SME market offers a big opportunity. There's 2.1 trillion in turnover, and that can help organizations better automate decisions with SMEs, manage their portfolios, and where required, act decisively when they need to do it. It's a challenging market, but equally it's a rewarding space to be in for your business, for your SME customers, and also the wider economy. And on that note, I'll hand back to Stephen.
Thank you so much, Ravi, and also Grant. Some really great insights today. And I think, as Ravi said, we're looking forward to release these insights on a quarterly basis moving forward to give you that unified picture of risk. So to close off today's session, if you are looking to unify your view of the SME lending opportunity we discussed, please do search for the DNB Unified Risk View to find out more. or follow the call to actions that will come after this slide. Thank you very much.